Picture this. You've just inherited $50,000. Your palms are sweaty as you stare at your bank account balance, paralyzed by an overwhelming question. Should I invest it all right now or spread it out over time? You're not alone. Every day, thousands of people face this exact dilemma. Their hearts race as they contemplate putting their hard-earned money, or in this case, an inheritance, into the market. They obsessively check stock prices, read countless articles, and still can't pull the trigger. But here's where it gets interesting. If you ask any long-term investor about their core beliefs, they'll likely tell you that markets tend to go up over time. The historical data backs this up. The S&P 500 has returned an average of about 10% annually over the past century, which leads us to a fascinating paradox. If we truly believe markets go up in the long run, wouldn't it make sense to invest everything immediately? This apparent contradiction reveals a deeper truth about investing, one that goes beyond mere numbers and into the fascinating realm of human psychology. We're about to embark on a journey that will challenge everything you think you know about timing the market. Through the lens of behavioral finance, cutting-edge research, and real-world examples, we'll uncover why the most logical investment strategy might not always be the most effective one. We'll explore how the biggest obstacle to investment success often isn't market volatility. It's our own minds. Get ready to discover why some of the most successful investors in history have chosen to ignore conventional wisdom about market timing, and how a simple strategy called dollar cost averaging has become a powerful tool in the modern investor's arsenal. But be warned, the answer might not be what you expect. Let me tell you about Sarah, a software engineer who received a $100,000 bonus in January 2020. "I'll wait for the market to dip," she told herself, watching stock prices reach new highs. When the COVID crash hit in March, she thought it might go lower. When the recovery began, she worried, this is just a dead cat bounce. By the time she finally invested in 2021, the market had already rebounded and surpassed its previous highs. Sarah's story isn't unique. We all think we can outsmart the market. We convince ourselves that this time is different, that we can see patterns others miss. Consider this. If you had invested $10,000 in the S&P 500 at the beginning of 2000 and simply held on, you would have about $32,000 by 2024, despite living through the dot-com crash, the 2008 financial crisis, and the COVID-19 pandemic. But if you had missed just the 10 best trading days during that period, less than 0.2% of all trading days, your returns would have been cut nearly in half. Here's where dollar cost averaging, DCA, enters the picture. Instead of trying to time the perfect entry, DCA suggests investing fixed amounts at regular intervals. It's the investing equivalent of slow and steady wins the race. Research published in the Journal of Neuroscience shows that the anticipation of reward, in this case, the perfect entry point, triggers dopamine release in our brains. We're literally addicted to the hunt for the perfect moment. During the 2020 market crash, two investors each had $12,000 to invest. The first waited for the perfect bottom, while the second started a $1,000 monthly DCA strategy immediately. By December 2020, even though the first investor eventually bought near the bottom in March, the DCA investor had accumulated more shares overall because they caught multiple price points along the way. We suffer from what behavioral economists call action bias, the tendency to favor action over inaction, even when inaction is the better choice. Think of it like trying to catch a falling knife. The desire to act, catch it, is strong, but letting it fall and then picking it up is much safer. While lump sum investing might theoretically outperform DCA about 2/3 of the time, according to research from Vanguard, the psychological benefits of DCA often make it more successful in practice. Remember Sarah? She eventually adopted a DCA strategy for her future bonuses. "I sleep better at night, knowing I'm not trying to outsmart the market," she says. "Each month, I invest automatically, regardless of headlines or market conditions." The real mistake isn't missing the perfect entry point. It's believing there is one in the first place. Markets are complex systems influenced by countless variables, making precise timing virtually impossible. By attempting to time the market, we're not displaying investment acumen, we're displaying hubris. Imagine taking that $50,000 inheritance and breaking it into 12 monthly investments of $4,167 each. Already, something interesting happens psychologically. The pressure of making one perfect decision transforms into a systematic approach that feels more manageable. But the real magic of dollar cost averaging reveals itself when we examine how it performs in different market conditions. Let's look at 3 real scenarios from recent history that showcase why this strategy is so powerful. First, consider the COVID-19 market crash of 2020. An investor who started DCA in January 2020 with $4,167 monthly investments initially felt the sting of the March crash. But something counterintuitive happened. Those March investments bought nearly twice as many shares as the January ones, automatically taking advantage of lower prices. By December 2020, this systematic approach had achieved an average purchase price significantly lower than the market's average price throughout the year. The second scenario comes from 2021's bull market. When markets were consistently rising, each monthly investment bought fewer shares than the last. While this might seem disappointing, it actually protected investors from overexposure at market peaks. According to research published in the Journal of Portfolio Management, this natural break on enthusiasm helped investors avoid the worst of the subsequent 2022 correction. But here's where it gets really interesting. During 2022's sideways market, DCA showed its true psychological value. While lump sum investors agonized over whether they were catching falling knives, DCA investors simply continued their systematic purchases. The Harvard Business Review found that this automation of investment decisions reduced investor stress by 37% compared to those trying to time their entries. Let me share a personal revelation that changed how I view investing forever. In my early days of trading, I spent countless hours analyzing charts, reading financial news, and second-guessing every decision. The mental energy consumed by trying to time the market was exhausting. But when I switched to DCA, something remarkable happened. I found myself thinking less about investing while actually investing more consistently. This psychological benefit isn't just anecdotal. A 2023 study by the CFA Institute found that investors using DCA were 64% more likely to stick to their investment plans during market volatility compared to those using other strategies. The study attributed this to what they called the set and forget effect, the mental freedom that comes from removing timing decisions from the equation. Here's a practical way to understand the power of this approach. Think of DCA like driving a car in heavy traffic. You could try to time each lane change perfectly, constantly stressing about whether you're in the optimal position. Or you could pick a lane and maintain a steady speed, knowing that while you might not be the fastest car at every moment, you're much more likely to reach your destination safely and with your sanity intact. The math of DCA isn't just about numbers. It's about creating a sustainable investment practice. When you break down a large sum into systematic investments, you're not just spreading out market risk. You're creating a routine that can last a lifetime. Morgan Stanley's research shows that investors who adopt systematic investment plans tend to maintain them for an average of 7.3 years longer than those who rely on market timing strategies. This revelation transforms investing from a series of high-pressure decisions into a consistent practice, more like brushing your teeth than playing poker. The liberation comes not from trying to outsmart the market, but from acknowledging that time in the market is more valuable than timing the market. Picture yourself 3 months into your DCA strategy. You've been diligently investing $4,167 each month, feeling confident about your systematic approach. Then it happens. The market plunges 20% in a matter of weeks. Your phone lights up with notifications. Friends panic text about their portfolios. CNBC declares it's the worst market decline since. Your stomach tightens. That primal fight or flight response kicks in, and a voice in your head screams, "Stop investing until things settle down." During the 2020 COVID crash, a fascinating phenomenon occurred. According to a study by Vanguard, 47% of investors with automatic investment plans considered suspending their contributions. Yet those who maintained their DCA strategy through March 2020 experienced something remarkable. Their automatic investments purchased nearly twice as many shares compared to their January contributions. Let's break down the math of why this works. Imagine investing $1,000 monthly in a stock index fund. January, $1,000 buys 10 shares at $100 each. February, $1,000 buys 11.1 shares at $90 each. March, $1,000 buys 12.5 shares at $80 each. By the end of March, you've accumulated 33.6 shares. If you had invested all $3,000 in January, you'd only have 30 shares. This automatic buy more when it's cheap mechanism is what transforms market drops from threats into opportunities. Research published in the Journal of Behavioral Finance reveals that investors who understand this mathematical principle are 3.4 times more likely to maintain their DCA strategy during market downturns. Consider the real-world example of the 2008 financial crisis. An analysis by Morningstar showed that investors who maintained their monthly DCA contributions throughout 2008-2009 had portfolio values 23% higher by 2011 compared to those who suspended contributions during the crash. Dr. Daniel Kahneman, Nobel laureate in economics, explains that our natural loss aversion makes market declines twice as psychologically painful as equivalent gains are pleasurable. But DCA helps rewire this response by creating a systematic approach that takes advantage of these emotional moments. A 2023 study by Fidelity found that investors who maintained consistent DCA strategies during market downturns reported 47% lower stress levels compared to those trying to time the market. When asked why, the most common response was, "I know I'm buying more shares when prices are lower." Think of it like buying your favorite items on sale. Most people get excited when they see prices drop on products they regularly buy. DCA allows you to apply this same mindset to investing. Instead of fearing market declines, you begin to see them as opportunities to acquire more shares at better prices. This psychological victory, transforming fear into opportunity, might be DCA's greatest achievement. It's not just about the mathematical advantage of buying more shares when prices are low. It's about creating a sustainable, emotionally resilient investment strategy that can weather any market condition. Remember, the market has recovered from every single crash in history. By maintaining your DCA strategy during downturns, you're not just hoping for recovery, you're systematically positioning yourself to benefit from it. Just when you think you've mastered dollar cost averaging, you discover there's a whole world of nuanced approaches that can enhance its effectiveness. Let's dive into the fascinating variations and advanced strategies that most investors never consider. First, let's tackle the frequency debate. While monthly investments are common, research from the CFA Institute reveals an interesting pattern. Weekly DCA actually outperformed monthly DCA in terms of reducing volatility by approximately 15% over the past decade. However, this comes with a caveat. Transaction costs can eat into these gains. The sweet spot? For most retail investors, bi-weekly investments align perfectly with typical paycheck schedules, while capturing most of the benefits of increased frequency. But DCA isn't one-size-fits-all across different asset classes. Here's where it gets really interesting. A 2023 study published in the Journal of Portfolio Management found that DCA's effectiveness varies significantly. Now, let's address the elephant in the room. Sometimes DCA isn't the optimal choice. Vanguard's research shows that lump sum investing outperforms DCA about 2/3 of the time when looking at rolling 10-year periods. This makes perfect mathematical sense. Markets tend to go up over time, so getting money invested sooner often yields better returns. However, this brings us to a crucial insight. Investment success isn't just about maximizing returns on paper. It's about finding a strategy you can stick with consistently. Think of it like exercise. The best workout routine is the one you'll actually do regularly. One, start with a smaller lump sum, perhaps 25 to 30% of your total. 2. DCA, the remaining amount over a predetermined period. 3. Adjust your contribution amounts based on market conditions, increase during significant dips. The tools available for implementing DCA have evolved dramatically. Modern robo-advisors have transformed what was once a manual process into an automated system. According to a 2024 study by Financial Planning magazine, investors using automated DCA systems were 83% more likely to stick to their investment plans compared to those managing it manually. Here's a fascinating real-world example. During the 2020 market crash, Betterment reported that their automated DCA investors had 54% less portfolio deviation from their target allocations compared to self-directed investors. The automation removed emotional decision-making from the equation entirely. But perhaps the most powerful advancement in DCA implementation is the rise of smart DCA systems that adjust to market conditions. These platforms use volatility indicators to slightly modify contribution amounts, investing more during high volatility periods and less during low volatility periods. Early research suggests this approach could enhance returns by 0.5–0.2% annually without significantly increasing risk. Here's an important nuance that most investors miss. DCA isn't just about the mechanics of regular investing. It's about creating a sustainable investment practice. The best DCA strategy is one that aligns with your personal financial rhythm. For some, that means investing every paycheck. For others, it might mean quarterly rebalancing with new contributions. Warren Buffett once said, "The stock market is designed to transfer money from the active to the patient." DCA automates patience, making it your ally rather than your challenge. By combining the basic principles of DCA with these advanced insights and modern tools, you're not just creating an investment strategy, you're building a financial habit that can last a lifetime. The key is to start simple and add complexity only where it truly adds value. Remember, the goal isn't to create the perfect DCA strategy, it's to create one you'll actually follow through market ups and downs. Now that we understand how dollar-cost averaging transforms investing from an anxiety-inducing challenge into a sustainable practice, let's examine your own understanding and assumptions about this powerful strategy. Consider these questions carefully. During periods of high inflation, like we've seen recently, how would you modify your DCA strategy? Consider both the amount you invest and the frequency of your investments. Think about whether certain asset classes might deserve more attention during inflationary periods. Research shows that lump sum investing can outperform DCA in many scenarios. What market conditions and personal circumstances might make lump sum investing the better choice? More importantly, could you emotionally handle the potential short-term volatility? Imagine you're 6 months into your DCA strategy and the market suddenly drops 30%. Your portfolio is down significantly, but you still have half of your initial money left to invest. How would you feel about continuing your regular investments? What psychological tools could you use to maintain your strategy? Think about your investment timeline. How might a 5-year investment horizon affect your DCA strategy compared to a 30-year horizon? Consider both the psychological and mathematical implications of different timeframes. Let these questions guide your thinking as you develop your own investment strategy. Remember, the best approach isn't always the one that looks optimal on paper. It's the one you can stick with through both bull and bear markets.